So thanks everybody for coming. Thanks a ton to Stripe for hosting us today. We're lucky to be here with, I think, a true business legend, Henry Kravis. Henry co-founded KKR in 1976 with his partners with $120,000 of their own money. Since then, KKR has scaled into one of the largest private equity firms in the world. It has over a $100 billion market cap as a public company itself, and has over $670 billion in assets under management, which basically means they're involved with some of the world's most interesting and important companies at real scale. And so if you think of the impact of that, it's truly enormous. Henry was one of the first to pioneer the private equity industry with the insight to create value by purchasing companies, using borrowed capital and operationally improving them, which is really key. And he and KKR are often credited with the rise of PE or private equity as an asset class. Beyond investing, you've also been involved with quite a bit of philanthropy, and I think we'll touch upon that a little bit as well. Education, the arts. You serve as a chairman of the director for the Partnership for New York City, Mount Sinai Hospital. You're involved with Sponsors for Educational Opportunity, and many other causes in terms of giving back. And so I think he's both contributed to the business world, but also to the worlds of education, healthcare, philanthropy, et cetera, over time. So thank you so much for joining us today.
Elad, thank you for having me. Happy to be here. And I guess you all didn't have anything to do better than come here, but thank you. Appreciate it.
Yeah, it's funny. I told him just in this front row alone, there's like a ton of amazing founders. And he's like, oh, they must be really bored tonight. And I was like, no. These people usually don't come out just for anything. So you started KKR in 1976 using you and your partner's initial own money or capital. Can you tell us a little bit more about how you got started? Why did you start this really interesting new type of business, and what motivated you?
Well, we got started actually in what is now known as the alternative investment area while we were at Bear Stearns. Jerry Kohlberg, George Roberts, and I were at Bear Stearns and bought our first company really in 1969, I believe, and sort of came about because a man came to see Jerry, who he knew, and said, I got a problem. And the problem is I've got a private company called Stern Metals, made dental equipment, and I don't want to go public. I don't want to sell the business. And by the way, I have a son who I don't think is capable of running the business. What do I do? And Jerry came up with the thought, well, why don't we form a group to buy the company? You keep 25%, we'll buy 75%. And we'll take care of your son so you don't have to have that burden. And that was the first deal we did. That was in 1969. We bought a number of companies in the 60s through Bear Stearns. Now, you have to understand, Bear Stearns never put a penny into any deal we did. They hated what we did. They were a sales and trading firm. And for them, long-term was overnight. For us, 5 to 10 years was long-term, and that's really what we wanted. We left the firm in 1976, and George and I were 32. We didn't have any money, and Jerry was older. George and I, first cousins, we each put up $10,000 to start KKR, and Jerry, being 19 years older, put up $100,000. So we started with $120,000, went out to raise a $25 million fund. You got to understand, there were no funds in those days, nobody doing what we were doing, and we couldn't raise money on terms that made sense. We dealt with a prudential insurance company, Mass Mutual, and but our idea was we saw a discrepancy in the market for companies, and that was boards of directors were not holding managements accountable. Institutions weren't doing much either except owning the stock. And companies were, in the 1970s and the early 80s, were really poorly run. And we felt that we could buy companies, and if you tie in management and make them an owner, as opposed to, I call it a renter of the corporate asset, actually make them an owner, they're going to act differently. And they're going to have the same interest in mind that the shareholders have in mind. So you have to have an alignment of interest between management and the shareholders. And our idea, Elad, was we thought we could buy companies and make them better. And that was our whole premise when we got started. And that's what we've done. But when we got started, you could buy a company maybe 7, 8 times earnings. Today, you're paying 15, 20 times earnings or more. And in those days, I'll give you an example. A company you all will know is Safeway. So in 1985, we bought Safeway for $5.6 billion. We put up $126 million out of the $5.6 billion, and that was for 100% of the equity. And that was called leverage. So you had $5.4 billion or $5.5 billion in round numbers of debt and $126 million of equity. At one point, we actually made, on a sale we made in the public markets, we had taken it private, then took it back public, we actually made about 50 times our money. Those are venture kind of returns. Now, what did we do? When we bought the company, everybody said, you guys are crazy. You can't buy a retail company. You got 1% margins. There's not much you can do with a company like that. Well, we found a terrific management team, which was actually the team that was part of our consulting group within KKR. We had our own consulting group in KKR. They went in to run the company. They took margins from 1% to 9%. And for a grocery store chain, it's incredible. Probably too high, quite frankly. But they knew where to spend the money. And, of course, there was no AI in those days. And so that you could lever a company to, just to put it in perspective. So today, if you buy a company, I don't care how hard you work at it, you still have to pay probably 15 times earnings for the company on average. You might be able to get the equity or debt, let's say, 7 times debt to EBITDA. So the rest of it, you're going to have to put in equity. So what went from $126 million, today you would have to put in probably $3 billion of equity. So that has really changed from where we were. Now, why did we get started? First of all, we saw this discrepancy in the market, and we really believed that we could make companies much better. And that's been our premise all along. But I want to back up for a minute, because something very important. When Jerry, George, and I had our very first meeting as KKR, May 1st, 1976, we had 2 conversations. First conversation was how to divide the economics. That was a 35-second conversation. Jerry, you take 40%, you're putting up 100,000, and George and I'll each take 30. And when we hire anybody else and give them equity, the first 10 points will come from you, Jerry, until we're even, and we'll come down after that. That was easy. The second part was just as easy. We came out of an environment at Bear Stearns, which was an eat what you kill culture, and we hated it. Everybody ran around and said, my idea, my deal. I literally, no kidding, had to lock my desk drawer at night, even though I was a partner at the firm, because I found people would come and rummage around, see what I was working on, because you were only paid on what you worked on or what you did. We hated that. So we wanted a firm exactly the opposite. We wanted a firm where everybody participated in everything we did, whether you're a partner at the firm or you were not a partner, whether you worked on a deal or you didn't work on it, whether you brought it in or you didn't bring it. It didn't matter. And the reason was very simple, because if we got the best thought process from the entire firm to help us, we thought we would do much better. So 49 and a half years later, we have exactly the same culture, except rather than having 3 of us, we now have 5,000 employees and 28 offices around the world, and not $120,000, but over $700 billion of assets under management, 45 different products. So got started really because we had an idea, and there was nobody doing it, that we could make companies better.
I think one of the things that you've talked about a lot, and I think is reflected in what you just said in terms of how you both quickly divided up equity amongst yourselves, how you thought about compensating early employees, how you thought about culture, is you've always had a really keen eye and focus on talent. And there's almost 2 types of talent in your business. I'm extrapolating. One is the management that you'll help bring on board or hire or get to reinvest in a company. The other is talent for KKR itself. how do you think about the key attributes of what you look for in employees for KKR? And how has that changed over time? Or what is a new thing that got added or something that got dropped?
Well, first of all, I'm going to start with the premise, and I don't know whether you all would agree with it or not, but I really believe very strongly in this, that I don't think you can be a great investor if you're not curious. And I'm not talking about curious just about your business, but curious about a lot of things. Curious about history, curious about the arts, literature, you name it, whatever it is. And I think that's very important. So what we're looking for are people that have that kind of talent in them, that they really, because we're only as good, we don't have a product. All we have is a lot of ideas and I think investing capability. But if you're not curious, so if I took somebody, any one of you, to the window at my office on the 77th floor at 30 Hudson Yards, and I said to you, what do you see out there? Oh, God, it's a trick question. Let's see. Oh, yeah, I see the tugboat in the Hudson River. I said, you failed. I want you to be able to see everything. You have to see the entire landscape because you got to connect the dots. You got to see possibility. There's a vacant lot over here. I can go build a building, whatever it is. And so what we're looking for are people that are willing to take risk. And I think that's one of the hardest things for young people that are investing today to do. We get all the best and the brightest from different schools, and they struggle to pull the trigger. They want, they used to come in with a 50-page memo, and it would tell you how many blue trucks in the business and so forth. It didn't matter a damn thing about the blue trucks. What we want to do is, how are you going to make this company better? How do you create value out of the investment we're making? And if you can't do that in sort of 4 or 5 pages, you probably don't understand the business very well. But all I can think about, and maybe I'm wrong about this, and that is that they're taught in school today to be able to answer every question. So when they come out, when they come into the investment committee, they want to make sure that they can answer every question. I'm waiting for the day for somebody to say, look, I don't know the answer to that, and quite frankly, I don't think it's that important. That, to me, would be great. But I won't tell you what I can do with the business once you buy it. I say, think about this. You run a model. You're running these models. So I'll say to him, how much money do you have? And say, well, what do you mean? And I said, well, I want to bet you every penny of your net worth that your model's wrong. I'm sure they're thinking it can't be. I went to Stanford, it can't be. How could that be wrong? So I said, I'll tell you why it's going to be wrong. We're either going to be higher than what you say the returns are going to be, or it's going to be lower. There's so many things we do. We're not just buying a stock, we're buying a company. So once you get control of a company, just think about all the things you can do. We can develop new products. We can go into new markets. We can sell a non-core subsidiary that's not doing return capital back to, we can refinance the company and there's lots of ways to get returns. And models that are run in the private equity world are static models. You go from point A to point B. I've never seen a model which had a downturn. Everything just goes straight up. That's not life, But that's how the model works. So you run a static model, and I wish that, that you think more like you're the conductor. You're the conductor of, or director of a movie. What do you want the movie to be? Where do you want it to go? How do you want this company to be? You're in charge now. You can do whatever you want with it. We didn't just buy stock. You now control the company. You control the board. You make the decisions. How do you want the company to go and in which direction? That, to me, is how we think at KKR, and we act and think like industrialists, and I'm using industrialists in a broad sense. Today, Elad, it takes so much more to be successful in investing in a company. It used to be very simple. Companies were so poorly run. Today, they're much more efficient, much more capital efficient, et cetera, and better run than they were. So today, we have over 100-person operating group within KKR. That is part of KKR. We have a 43-person macro and asset allocation group. We've got something called the KKR Global Institute, headed by General David Petraeus, to focus on regulation, to focus on geopolitical issues as we invest all over the world. We've got a very large ESG team that focuses on, because regulations, environment, government situations all play an impact today on investing if you're going to buy a company. We've got a capital markets team today, which we never had before, because we do the financing ourselves. So the question is, how do you refinance a business once you have it? What's the right capital structure for it? And it used to be that our teams worked on the deal, they would do the financing too. That's a waste of time. So we have a capital markets team that do the debt and the equity placement, and we go from there. So the world has changed as far as investing. So what we're looking for are people willing to take risk, people who are innovative, people who are curious, and I want people to tell me the mistakes they've made. If you ask me, what are the mistakes you made, we'd be here all night, because I can tell you every mistake that we have made, and most of them were just stupid mistakes on our part. We went into industries we shouldn't have. We're going in the auto parts business in Japan and bought Fiat's auto parts business, and then doubled down buying Nissan's business. And so, that was a mistake. Bought Toys R Us. Didn't change the management fast enough. What am I looking for also? I'm looking for people that aren't afraid to make management changes. One of the things I can almost assure you is that what you see in an executive is what you're going to get. I'll repeat that because it's really important. People don't change. You can fix them around the edges, particularly if it's a CEO of a company. And I'll tell you a quick story. In 1978, we bought a company called Lily Tulip, and they made paper plates and cups. McDonald's was the largest customer. And we bought that company, and in the first year, the management didn't even come close, that we inherited with the company, didn't come close to meeting the budget. Okay, I said, you got to do better. Second, went through 2 more quarters, not much better, and I said, I'm going to have to let you go. And he said, you can't let me go. And I said, why is that? He said, because you're going to lose the McDonald's account. So I was young, and I thought, well, geez, maybe he's right. So I let him go 1 more quarter. I said, I've had enough. I'm going to bite the bullet. I let him go. I called the head of purchasing at McDonald's. And I said, we've just let this guy go, and I hope you'll still do business with us. And he laughed. He said, first of all, we do business with the company, not with any one person. And by the way, the only thing I liked about that guy was that he used to take me hunting every year. And that was a lesson for me, because now I promise you, what you see is what you get. And if you look back, if I look back and say mistakes I made, I didn't move fast enough. And I ask that question oftentimes to CEOs of major companies. And I said, do you agree with me? And I've never found a CEO yet that has disagreed with that statement. He said, most of them will tell me, I'm sorry I didn't do it faster with people I had in my company that I should have moved out.
One of the best anecdotes I've had recently where I was talking to a founder about people not changing was we were talking about employee happiness and how do you cause it and all these things. And he said, well, the number one way to have happy employees. And I said, what? And he said, hire happy people. And I thought that was actually a real good insight, because if you think about it in other aspects of life, who your partner is, dating, whatever, you're like, oh yeah, I'm not going to try and change somebody into a happy person. So why would you do that in the context of an employee? And to your point, I think there's a lot of other traits like that are things that people are at the job with, and they either build on those and get better, or they're not going to change. And so I think that's a really great insight.
So just to continue on with what we're looking for, we go through an interview process, and we're probably, for hiring people at KKR, because we have this culture of inclusion where everybody participates in everything we do, and even today, it's exactly the same culture we started 49 plus years ago. And so when we're hiring senior people, we want to take them out for dinner. Because it's funny, if you get people away from just across a conference table, and after they've had a glass or two of wine and they relax, watch them. What do they say? How do they treat the waiter or waitress? How do they treat their partner they're with, et cetera? These are things we're looking for. Do they talk about themselves all the time? If I'm interviewing for a CEO for one of our companies, and they come in, and all I hear for an hour is I did this, I did that. Whoa, stop. Did you have a team? No, nobody. I don't care who you are can do it by yourself, and you all know that. But I can't tell you how many times people come in and they were trying to impress you, and they only talk about themselves, and that's a big mistake.
Absolutely. One thing you talked about is the degree to which the industry has been changing over time since you helped really pioneer it at this point almost 50 years ago. And you mentioned changes in terms of operational efficiency of the companies and excellence there. Obviously, there's been changes in scale of this business in terms of private equity and the size of roll-ups or buyouts that people have done over time. What do you think is coming in the next 10 or 15 years in the industry, or how do you think it changes, or do you view it as more static now?
Well, first of all, people keep talking about it as the private equity industry. It's not private equity anymore, or only that. Today, just take KKR. Today, we've got over 45 products. We're global, 28 offices. And if you go back when we started, there were only maybe four or five banks that would lend on a cash flow basis. And that was First Chicago, Continental Illinois, Bankers Trust, and Manufacturers Hanover. Now, probably most of you never heard of those banks because they're all gone now. But that's all there were. And you had to go to the Prudential Insurance Company or Mass Mutual, Connecticut General, and one or two other insurance companies. And the way that we would put the structure together, and literally George and I would have to back into a capital structure. How much capital was available in each of those pots? Today, there's money everywhere. So in those days, if a deal was halfway large and you didn't get the Prudential, you couldn't get the deal done. There was no high yield market. High yield market didn't come into effect until the mid-'80s. So, and that was Mike Milken's doing. It was brilliant. And so that really changed the market totally. And so I say, don't talk about the private equity industry, talk about the alternative investment industry. Because, like I say, we've got 45 products at KKR. They range all the way from credit products, private equity, growth equity. We don't do venture capital at KKR. But we've got, we have real estate. We've got an insurance company, Global Atlantic, that does life and annuity business. We have infrastructure investing, and we have a capital markets business. We have a climate fund. We have an impact fund, and so forth. So I wouldn't call those just private equity. They fit into the alternative investment area. So the things that have really changed, it takes a village today in Hillary Clinton's parlance to buy a company. It used to be simple. George and I just go and buy a company. It used to be literally, we bought Beatrice Foods for $8.6 billion. And I had called the banker and I said, do you think that they would sell the company? Because I just saw they fired the CEO, and George and I have been chasing this company, and the guy wouldn't even talk to us. And when they fired him, and he said, well, I don't know, I don't think so. He said, and by the way, if you have anything to say, send us a letter. So I called my secretary in, I dictated a letter, no lawyers, nothing, sent it out to them, and the next thing I know, I get a call back and said, this interim CEO, and I'll come see you. and we bought the company. That's pretty simple, straightforward. Today, everything's an auction, or most things are auctions today. You've got to go through all sorts of regulatory issues, which is totally different than what we used to have to do. And there's money everywhere today. There's probably not a bank in the world today that hasn't lent to some alternative investment that has come into them. It used to be, as I said, there were 4 banks. That has changed dramatically. The high yield market changed dramatically. It used to be just Drexel Burnham. Then it became everybody on Wall Street was doing that. The banks all do it today. And so there's plenty of capital. There's more competition than there's ever been today. And you just have to be smarter and pick your spots. Where can I make a company better, in our view?
We have a lot of founders, CEOs, builders, engineers in the audience here today. And one of the sort of trends that's happening right now, at least in Silicon Valley, is more and more people are getting excited about doing roll-ups, but in the context of a deeper application of AI or software or technology as part of that shift in terms of the margin structure or leverage on the business. How do you think about that, or what do you think is important in addition? If you are trying to do an AI-driven roll-up, like how should you think about that, or what other factors should you consider?
You know, George and I have had an unbelievable partnership. We ran it together, ran KKR together for 45 years, and finally we got a promotion up to executive chair, co-executive chair, which is great. I said I'd go buy one company and I'd use it as a vehicle. And I said I wouldn't go out and raise a fund. You know, the world needs another fund like a hole in the head. And I don't care what kind of fund, whether it's a venture fund or private equity fund. I mean, there's a fund for everything today. So I would have bought one company and I'd use it as a roll-up vehicle. And I would find as, you know, the best CEO I could find. Now, I'm in AI land out here. I got it. I understand. You know, everything's going to be autonomous. Everything's going to be run by AI and so forth. And I talk to a lot of people that are now doing roll-ups and they're putting AI in. I think that's great. Except there's a couple things you have to add. You better have good management because AI is not going to run the company. That's a productivity improvement, absolutely, without a doubt. And we put AI in our companies, and it does improve productivity without a doubt. You can improve your margins without a doubt, but you got to have a corporate development guy because he's got to go find the companies. You better find companies where the cultures fit, because I've seen more companies that say, "Oh, I can just go buy companies," and they start buying all these companies, and the cultures have a collision. And they don't fit, and the companies blow up. I've seen situations where you buy all these companies and you don't integrate them. So you're not getting the benefit of buying the other companies. You buy them and, yeah, you've gotten bigger, but you haven't become more efficient or more profitable because you never integrated. So you got to figure out how to integrate. So, you know, being, you know, doing roll-ups and using AI, that's just a tool. And it's not going to, you can't have AI run the business. You have to have a really good management team that's going to run the business and use AI as a component of how you run the business and how you run it more efficiently. And the idea is if I can buy all these and at a, say, a 6 multiple, 6 times EBITDA, and once I have size and it looks like I'm really growing quite fast, then I can, I'll trade it 12 or 15 times. The problem today, that arbitrage is closing because companies are waking up and say, whoa, I'm not going to sell my company at 6 when I look at comparables and the whole business are trading at 15. So you don't have the same arbitrage that you used to have in a lot of these roll-ups. And so, you know, as I say, AI is great in these roll-ups, important, but you better run the company, and most importantly, you better have a culture that fits, because you don't have a culture in these companies, I promise you can have all the AI you want and it won't work, because you're going to have the management blow up.
One thing you've mentioned a few times is your cousin George, with whom you've started this business and who you've had a decades-long partnership with. What do you view as the key of having a sustainable partnership over such a long time period? Or how did you navigate that? And what advice would you give to people as they look at their own co-founders or people that work
George
with?
Roberts is my closest friend, we were cousins, first cousins, and we met when we were 2. So people ask us, said, you two must really fight a lot. I said, yeah, that's true. I think the last fight we had, we both were 7. I got a new bicycle, and I was in Tulsa, and he came up from Houston, and I wanted to, it was a Christmas, and I wanted to ride my new bicycle first, and I was told I was a bad host, and I got chased in the house by the housekeeper, and I ran in the corner of a wall, cracked my head open, had 26 stitches. That's the last fight we've had. So, first of all, we've been close friends. Went to Claremont together, spent summers together, drove cross country from Claremont to New York. He worked at Bear Stearns in the summers, and I worked at Goldman Sachs. You know, if you have the same values, Elad, and you have the same objectives, it's amazing how far you go. And if you don't worry about who gets credit, I'm pulling for him and he's pulling for me. And that's how we've made this work. Now, about 3 years ago, George and I moved up from co-CEO to co-executive chair. And we brought on 2 fantastic guys that had been at the firm for 25 years. Joe Bay, who had started Asia for us, and Scott Nuttall, who had started our credit business and our capital markets business and some other things. And they were really close friends. And that changeover literally took us 7 years. George and I started thinking about it 7 years before we finally, and we started with 7 people, and we moved them around, and we narrowed them down to 3, and we had a choice. You pick 1, you're going to lose the other 2. You pick 2, you're going to lose 1. So, and you got to pick 2 that are really close. So one of the most important things that we thought about when we were passing the mantle was, one, and most important, number 1, do they believe in our culture? They live our culture, and they do. Secondly, how close are they? Well, they're really close. They came into the firm within a month of each other, been there 25 years, when we made them chief operating officers first, which they were for 4.5 years before we promoted them to co-CEO. And so George and I, today, it's pretty simple. I seem like I'm busier today than I was before, but I'm doing more things that I enjoy doing. And so, and we work very closely with Joe and Scott, and we meet basically every 2 weeks officially. Our offices are right next to each other. George is out here in California, but Joe, Scott, and I are in New York on the same floor and just down the hall from each other. And we're in each other's office all the time. So if you don't worry and you really are doing the best for what's best for the company, you can really, as I've said, you can go a long way.
So I think we're going to move to a lightning round now, and then just 2 or 3 questions for that, and then we'll open up to questions in the audience. I guess the first one is, if you could have dinner with anyone, who would it be?
That's easy. I'd have dinner with my wife. I know that's not what you're looking for, but I'm telling you that's true. My wife's brilliant, so I love having dinner with her.
It's actually interesting. So I met Henry through his wife originally, and this was years ago. And the number one thing that people would say when they described her was that she's very smart. And so every conversation I ever had was, you have to meet this person. She's incredibly smart. She's incredibly talented. And so I definitely understand your answer. So if you could go back and talk to 32-year-old Henry Kravis, just as you were leaving Bear Stearns, you're starting KKR, what advice would you give yourself or give him, given what you know now?
Look, I've always been a risk taker, for right or wrong. In fact, I had no money. I had 3 children. George the same, 3 children, no money when we started KKR. And we went out to raise a $25 million fund and couldn't raise it on terms that made sense for us. So there we were. Well, you all are entrepreneurs in this audience, and you're either going to get through the wall or over the wall, but you're going to get to the other side. And that was how we were. We were entrepreneurs. and except we're just old entrepreneurs now. We've been doing it for so long. And so the thing was, we said, okay, how much money do we need to run the business? And we sort of held our finger in the air and said, okay, $500,000. So let's go to 8 individuals and ask them to put up $50,000 each. That's $400,000. And we said, if we buy a company, we'll get a fee, and that'll be the other $100,000 that will cover our overhead. And all we wanted to do was get set up so that we could survive for 5 years. And we said, we've got to get going because we have no job, no money, and 3 children. And so that's not a great position to be in. And so I look back and I say, okay, what was it that I would do differently? I said the only thing I'd probably do differently was I'd move on people faster, which I talked about earlier. That's the one thing that I wish we had learned very early on.
Okay. And then last question before we open it up is, what do you think is the best advice you've ever been given?
Best advice, well, I'm going to reframe it, if I may. I'd say the best opportunity I've ever been given, and this was instructional to me. When I just graduated from college, and I had worked my first 3 summers at Goldman Sachs. After freshman, sophomore, junior year, my senior year, then I went to work for a fund because I wanted to see how a fund made decisions on buying stock. And I arrived, and Ed Merkel was running the fund. And he said, he used to call me Kid. He said, Kid, and I was just there for the summer before I went on to get my master's at Columbia. And he said, I want you to follow these 2 industries, and I want you to buy stock. And I said, well, Mr. Merkel, I've never bought a stock in my life. And he said, doesn't matter. We got bumpers here. You're not going to blow us up. And so he basically just threw me in. And I'm positive a monkey would have done just as well, but everything I suggest we buy went up. Well, the whole market was going up, but he didn't pay attention to that. He just thought I knew what I was doing. So one day he comes in and he says to me, Kid, I want you to go call on Roy Disney. And I said, well, that's not in my group. And he said, I know, but I want you to go out to California and Los Angeles and meet with Roy. Walt and he had started the business, and Walt died the year before. This is now summer '67. And I said, who's going with me? He said, no one. So the best advice out of that was he just basically threw me in. And he said, you're going out there alone. Now, I'm a kid who's just graduated from college. I am scared to death to be sitting with Roy Disney. And I studied everything I could study. I looked at every annual report going back, 10Ks, 10Qs, footnotes, you name it, research reports. And I got out there, and Roy Disney said to me, thank you for coming, 9 in the morning. I've got an hour for you. And had he said 15 minutes, that'd probably been fine too, because I am scared to death to be sitting there. Got halfway into the conversation, and he said to me, geez, you know a lot about my business. I didn't tell him I'm scared to death, and the reason I knew what I did was because I had to study everything. And he said, I know I told you I had an hour for you. He said, I'll tell you what, I want you to spend the day with me. He said, most analysts that come out here haven't even asked, haven't even read my annual report. They just expect me to tell them everything. So the lesson out of that for me was if you've done your work, you can go a long way. He never asked me, was I a partner at the Madison Fund or was I a summer trainee, which I was. All he cared about was that I cared about his company, and I spent the time to study it. And so if you do your work and you're prepared and don't try to cut corners and think you can wing it, because you can't wing it, you can go a long way, and people pay attention to you, and they don't care how old you are. And at the end of the day, he took me on a tour of the studio, and I thought I'd died and gone to heaven, spending the day with him.
That's great advice. Maybe we can open it up for 2 or 3 questions from the audience. And I think there's microphones coming. So
is there a microphone or something?
When you purchase a business, like what are beyond management hires and improving the management team, what are the core kinds of levers that you're targeting? Is there some through line with the types of things that you're focused on for a business?
And I'll just repeat the question so when this goes up on YouTube, people can hear it or understand it. So I guess the question is, when you buy a business, what are the through lines or main points of leverage that you look for in that business?
So one of the things that's very important, where does this company fit in an industry? Does the industry have growth or not, or is the entire industry broken? And if it's sort of number 7, out of 10 companies, probably no interest. But if it's 1 or 2 or 3 and you can buy it right, that makes sense. You want to find out where it is in the industry. Number 2, can we make that business better? If we're going to buy the company and the only thing we can count on is hoping that the multiples will increase, that we can actually get a higher exit multiple when we exit or take it public, that's a bad deal. We have to look at it and say, can we make it better, and how can we make it better? That's very important. And 3, I would say we look at the management. And now, the first thing we do, once we have an agreement, and we've signed an agreement before we even close, we'll start working on a 100-day plan. How to improve the business, and that's where our consulting group comes in, and the team that's working on the deal, plus the consulting group called KKR Capstone, will go in and work with the management. And we'll evaluate the management early on, but then you get a better look at them between the time you sign a deal and you close. So those are the 3 things we're really looking for, and can we improve the productivity in a company? And I say make it better, that's all part of it. Will AI help? That's just part of productivity improvement, et cetera.
Okay. Next question, maybe in the middle. Oh, go, please, choose.
James?
Well, you spoke about how KKR doesn't do venture capital investing,
Right.
but you yourself are very, very prolific both in funds as well as startups. I'd be very interested in just hearing you speak about that side of your personal investing.
So the question is, my personal investing is in venture capital, and KKR doesn't do it. And that's true, as I said, because that enabled me to do it. I started doing this in the dot-com period, 1998 to the 01 period. And I'd come out here to Silicon Valley, and I'd talk to all these geniuses, and I'd say, okay, tell me what your strategy is. Oh, that's easy, Mr. Kravis. We're going to go public. Okay. Why don't we try that question again? No, you don't understand, Mr. Kravis. It's all about eyeballs. I said, so what do eyeballs do? They're looking at the screen. Does money come out of the screen? I don't get it. They had not a clue what to do. All they wanted to do was get rich. And so the only thing I'll say about that period, I had an airplane that I had owned for 15 years. I paid $20 million for it 15 years earlier. And all these geniuses had to have a plane, because if you didn't have a plane, you were nothing. And so I sold my plane for $21 million 15 years later. So, yeah, so that was then. Fast forward, and I started investing, and one of the reasons I do it, now I'm really all in, but I did it because I'm curious, and I love what young companies are doing, what entrepreneurs are doing. It keeps me fresh in my thinking. As I said, I don't think you can be a great investor, and maybe a great manager for that matter, if you're not curious. So to me, that's just part of my whole curiosity there. I love learning from those companies and those people. And so today what happened was, about 4 years ago, head of my family office said, do you know how many of these companies you have? I said, I don't have a clue. And he shows me a list. I said, oh my God, you guys are accountants and lawyers, you're not investors. We better hire somebody who knows, can oversee the company and help us. So I did a search, and I was really fortunate, and I came up with my venture partner now, Jed Linsner, who had 8 years experience at Allen & Company and then went to Tusk Ventures and joined me almost 4 years ago. And he, in turn, has hired 2 terrific people, Ryan Joseph and Olivia Schmidt. And so I just enjoy it. I have more fun doing it. Let them do the work, and I get all the pleasure out of it. Other questions? Yes, right here.
In scaling KKR from a few people in a room to a 5,000-person global company, what's been the most challenging skill that you've needed to master as you've led the company to scale?
I don't know if you heard that, but the question is, as we've grown from 3 people to 5,000 people, what's the most important skill that we've had to focus on to master the growth? I'd say the most important is culture. That is the number one. If you don't have a culture and you have people who fit in and live by it, when we made some acquisitions just for KKR itself, not for our funds, like we bought Global Atlantic, which is an insurance business, an annuity business. We spent more time focused on their culture with that mesh with our culture. When we hire people today, particularly senior people, they may have, this will sound strange to you, they may have as many as 20 or 25 interviews. And what we're looking for is a consensus of people. It's not, yeah, I can hire anybody I want, but we want people say, no, this person would be great, they would definitely fit in, and that would be important. So I'm also looking for people that made mistakes. If you're not making mistakes, you aren't doing anything, number one. As I said, I could give you a chapter and verse about mistakes that I personally have made and that we've made at a firm, and why we made those mistakes. And so we're looking for people that fess up. I want to know, one of the things I do, if I'm meeting with an institutional investor or a family office, sometimes I like to start with, I said, I know you're going to think I'm going to tell you all the great things about KKR. I am. I'll get to that. But I want to tell you the mistakes first. They are so caught off guard by the fact that I would talk about mistakes we've made, and we make mistakes. You're human. And fortunately, the record is extremely good. It's picking the right people, make sure they fit in. These interviews are very important to us. And I say, the other thing is get people out of their comfort zone. I'll tell you a story. We all can interview across a table, just not that hard. So a friend of mine, Tom Cousins, had a company called Cousins Properties, and he had started the company, decided he wanted to move up to become chairman. So he was interviewing a CEO, thought he had the guy. He said, well, I'll take him to Augusta to play golf, and he invited one of his directors to go with him. And I don't know how many of you play golf in this audience, but when you're on the green, you can pick the ball up, put a marker behind the ball, and clean it. This guy would put a marker in front of the ball, pick it up, clean it, and put the ball in front of the marker. Maybe you get that much advantage. And he watched him do it a few times. Now, he would never have seen that in just across a conference table. So the thing I would tell you is, does the person fit your culture? Does the person own up to their mistakes? Does the person have an innovative bone in their body? To be creative, because if you're not, it's just you're just a machine. And so those are the things that we're looking for, and do they believe in our culture, which is a culture of inclusion? And if they only want to be, me, and I don't want to go to any meetings. We have guys who made us a ton of money. We fired them because they wouldn't go to meetings, they wouldn't help anybody else, and they'll ruin a place. Our culture is one of everybody participates in everything. To this day, we pay everybody off the balance sheet. And it doesn't matter whether you're based in Sydney, Australia, you're in New York, San Francisco, wherever you are, in any one of our businesses, we pay everybody, and we're going through that process right now because it's year end.
Okay, last question, please.
One over here, I think.
First of all, thank you both so much for being here.
I can't hear you, I'm sorry.
Oh, sorry, I said thank you so much both for being here.
Thank you.
You mentioned the importance of curiosity, and I'm very curious, what are some ways that you continuously keep on learning about the world and just the state of markets?
So the question is, talking about curiosity, what are the ways that I personally keep myself learning and learning about the world and so forth? Well, number one, I love reading. So I read history, I read biographies. Number two, I love traveling. I travel all over the world constantly. I used to be in Asia 4 times a year. I'll go anywhere because I love meeting people. I love learning about cultures, and that's really important in my view. Philanthropically, very involved in 3 areas. My wife and I, one in cancer care in particular, and in medicine and science. My wife chairs Memorial Sloan Kettering's Research Institute. I'm very involved with Mount Sinai Hospital in New York. That's on that side. Secondly, education. I chair something called Sponsors for Educational Opportunity, and I've done that about 12 years now. I love it. These are underserved students who we can get through high school and college. It's an 8-year program, and that keeps me focused on that part, which is a very important part of society in my view. And the last are the arts. So I'm constantly going to museums. I go to galleries, and anytime I'm in New York or travel, if I've got time, I want to go to a museum, because just looking at paintings, in my view, it opens my eye. I like looking at furniture, different design. And so, I used to be the most boring human being, I promise you, when I was young, because when we started KKR, all I wanted to do was talk about business. I go to a cocktail party, all I want to do is talk about business. And all of a sudden it hit me in the head, you are boring as hell. Why anybody want to listen to you, I don't know. And I said, okay, we're going to change. And then I started expanding there. And so coming here, you say, well, why'd you do this? Well, I did it because I met Elad. I don't know, we were trying to figure that out probably about 2015 or 16, something like that. And it was through my wife. I became fascinated with what Elad was doing. And by the way, I don't know what you all think, but today's been Elad's day, I got to tell you. As I was going around, they said, we hear you're going to go do this fireside chat with Elad. He's one of the best investors in the Valley. And you didn't pay me to say that either, I know.
My mother did, so
Okay.
she's very good to me.
So it's just trying different things, and I'd sum it up by telling you, get out of your comfort zone. The worst thing, most people, there's one sentence I tell young people to take out of their vocabulary. I wish I had. Think about it. Don't look back and say, God, I wish I had tried that. What if you try it and you fail? So what? You live in a great country. Got that ability. Pick yourself up and go try it again. Think about the number of entrepreneurs that failed and tried the second time and got it right, or the third time and got it right. Get out of your comfort zone and go try things. And even if you fail, you're going to learn from it. So
I think that's a wonderful place to end. Thank you, Henry, so much. And,
thank you.
and a big thank you to Stripe as well for hosting us, and thanks again.
Thank you.